Investing all your money in one place can be a risky move, and that's why the phrase, "don't put all your eggs in one basket," is so often cited as good advice. This proverb encourages investors to consider carefully where they invest their money and how they build their overall investment portfolio. In essence, it is essential to diversify your investments and spread your money across various stocks and assets. A well-diversified portfolio is an integral part of any successful investment strategy, providing both protection and opportunities for growth. If you are looking for ways to diversify your portfolio, continue watching this video till the very end. Diversification is a term used in the investment world to describe the practice of purchasing various types of assets. These different assets, collectively known as your investment portfolio, can include stocks, bonds, real estate, commodities, and more. The goal of diversification is to spread your investment risk across multiple assets, rather than concentrating it in one or a few areas. Diversification can be achieved in many ways, which we'll explore shortly. But perhaps the most important aspect of having a diversified portfolio is that it offers a degree of protection against potential losses. If you put all of your money into one investment, and that investment suffers a significant loss, your entire portfolio could be at risk. In other words, diversification helps you to avoid the risks associated with having all your eggs in one basket. Just like if you had spread your eggs between the fridge and the table, if one of your investments suffers a significant loss, you'll still have other assets in your portfolio to help you weather the storm. This is why diversification is considered a key principle of smart investing. Designing a diversified investment strategy is not a one-size-fits-all approach. The ideal investment plan for you will depend on various factors, including your age, gender, retirement objectives, and income. To start, you need to understand the different types of assets you want to invest in. The stock market provides numerous options, but the three primary asset types are stocks, bonds, and commodities. Stocks represent partial ownership in a company, while bonds are loans made by investors to entities like governments or companies. Commodities are tangible products like wheat or gold that can be bought and sold in the market. To further diversify within a single asset class, you can consider buying individual stocks or investing in mutual funds. If you purchase stock in a specific company like Nike, you have a single stock holding. However, if you invest in a mutual fund, you have exposure to a collection of different stocks. By doing this, you are diversifying within the same asset class. So if one company, such as Nike, performs poorly, you still have the potential for gains in the mutual fund. Investors can diversify their investments in other ways, such as geographic diversification and sector diversification. These strategies will be discussed in more detail later. By employing various methods of diversification, you can reduce the risk of losses in any one area, increase the potential for gains, and protect your portfolio from market volatility. Investing is a personalized experience, and what works for one investor might not work for another. That's why there are different asset allocation models that can be tailored to suit individual investment goals, risk tolerance, and time horizon. Each model emphasizes a different aspect of investing and will perform better in certain markets but not in others. The goal is to create a portfolio using an asset allocation that incorporates all four models in different measures based on your preferences. Comment investing if you like us to make more videos on investing. If you're uncertain which model would work best for you, it's advisable to seek the help of a wealth manager who can provide professional guidance. Wealth managers use technology to automate some aspects of investing while still providing access to a dedicated financial advisor. You can find fiduciary wealth managers near you by using directories like Paladin Registry. Now let's take a closer look at each of the three asset allocation models. It's essential to remember that none of these models are pure plays in their stated categories and can be modified to suit individual preferences. Number 09. When constructing an investment portfolio, it's important to consider different asset allocation models that match your goals, risk tolerance, and time horizon. One such model is the income-focused allocation model, which emphasizes investments that generate steady income with a relatively low risk of losing the principal investment. While income-focused assets like U.S. Treasury securities corporate or municipal bonds, and high dividend-paying stocks come with some degree of risk. They also offer the potential for market growth and higher returns than a low-risk investment like a certificate of deposit. Investors should be aware that the risk level of this model depends on market factors and the creditworthiness of the issuing institutions. Nonetheless, the income-focused model can provide a reliable source of income even in uncertain market conditions. Number 2. Growth and income. A growth and income investment strategy aims to provide both capital appreciation and steady income to the investor. Unlike the income model, which focuses mainly on the security of principal, the growth and income model invests primarily in dividend-paying stocks with less emphasis on treasury securities or bonds. The idea is to generate steady income from equity investments in stocks, enabling the portfolio to provide capital appreciation in addition to the regular income. This strategy can be one of the best long-term performers because it focuses on investing in stocks with a history of regularly paying dividends and steadily increasing them. Number 3. Growth. A growth asset allocation model is designed to achieve above-average capital appreciation primarily through investing in stocks, particularly those with above-average growth potential. While some stocks in the portfolio may pay dividends, the focus is on companies with a track record of growth rather than income. The portfolio typically consists of blue-chip stocks with a history of growth and a small allocation in treasury securities. In addition, some stocks in the aggressive growth category may be included to achieve more predictable growth than can be achieved with more aggressive investments. Diversification, or spreading your money across different investments, can provide a valuable benefit for free. For example, if you invest equal amounts in asset A and asset B, both of which either go up 6% or down 4% per year, but with perfectly offsetting ups and downs, you can eliminate all the risks associated with holding just one or the other. Even if one asset declines by 4%, the other asset will increase by 6%, ensuring a 1% return with no risk. This diversification strategy can be done by all investors, with no additional costs. While the example given earlier may be an exaggeration, diversification is still a valuable strategy for investors. Although it is impossible to find investments that perfectly offset each other, diversification can still lower risk without sacrificing returns. However, there are some downsides to diversification that investors should consider. Firstly, spreading investments too thinly can lead to missed growth opportunities, and too much diversification can negatively affect the bottom line. Additionally, diversification cannot fully protect investors from a general market decline, as all asset classes can decline simultaneously during a market meltdown. Overall, diversification should be used as part of a comprehensive investment strategy that takes into account an investor's risk tolerance and investment goals. So that's it today for you guys. Hope you liked the video. If you liked the video, don't forget to like, share, subscribe, and comment on your investing experience. We hope to see you in our next video. Ciao.